So recession watch, folks. These days, I don't know, when it comes to Wall Street, it reminds me of my favorite Twilight Zone episode where everyone decides that these aliens are our friends. But there's one researcher who cracks the code. Unfortunately, it was too late for her to save her colleagues from being whisked away to their planet where they were put on a menu with all the other Earthlings. Well, my next two guests never stopped working to crack the code, which is why their work is incorporated by so many on Wall Street. Joining me now, Chief Economist at New Century Advisors, Claudia Sahm, along with our friend Michael Kantrowitz at Piper Sandler. Hey, Claudia, by the way, both of you in recent months have seemingly backed off your own work, or at least the implications of your own work. Claudia, let me go with you. I mean, are we now potentially on the cusp of recession?
The Sahm rule, the recession indicator, I think a lot of what we see in the labor market, it's sending the right cautionary message. Things have cooled off. We should be concerned. And yet in the context of a very unusual, very disrupted economy of the past 4 years, they're not flashing red. I mean, we have to set these in context, and that's been tricky because this cycle kicked off by the pandemic.
Are they flashing yellow?
Yes.
Okay.
Yeah, no, there are very serious reasons to be concerned about the labor market. Not that we are on the edge of a recession or we're just right in one, but those are very serious risks. Being headed towards potentially 3 months, 6 months, we should be thinking about that, and there are policymakers that should be thinking hard about that. Those risks.
Mike, a couple months ago when we had Lydia mentioned the 6.9 million, up 13% year over year with the unemployed number. I saw an article where you kind of downplayed it a little bit. Where are we now with your work?
Yeah, it's that my rule triggered 3 months ago, and it's continued to rise. We've got about a 12% increase in the year-over-year change in unemployed people, and forward-looking indicators that I look at that have been consistent across history, i.e., 80 years of data, are still pointing for that to continue to move higher.
So Goldman put out a note saying that there are fewer immigrants, right? Fewer migrants coming into the country. So right now they say 150,000 monthly jobs will keep the unemployment rate stable. Mike, are you buying that? And how do you factor that into your work?
I think it's difficult to dispute it, but I also think it's difficult to attribute the entire rise in unemployment due to labor supply, given all of the anecdotal data and alternative data that employment has been showing you, like losses in temp employment, hours worked declining, small business hiring declining, profit growth slowing. So we have all the signals there, and I agree with Claudia. The economy's not falling off a cliff, but there's a lot of warning signs that suggest it's not just a supply story.
So, Claudia, let me pick up on that. On the supply side, with respect to the migrant story, which has been something very unique to 2024. Also on the demand side, because there is growing speculation that all of this government job, which is mostly state and local, a lot of that money actually came from the federal government a year ago, and that may be running out. So how would that sort of impact your thinking?
Both of those are examples of us rebalancing the economy. The labor shortages were huge early in the recovery, and then we had a big increase in immigration. That helped, among other workers coming in, to solve that. So that's been a good story. It pushes up maybe temporarily the unemployment rate, and yet maybe not if the demand isn't there. And as with the state and local sector, they have been a big part of the job story in the last few months, or in the last several months, but they were ones that had a lot of catch up to do on hiring that they didn't do earlier. So these things can all be part of a good news. We're getting everything back in order and balance, and we can move forward. But they are all consistent with if we have further weakening in demand for workers, we start to see the layoff rate move up. We're close enough to the danger zone that you're moving into a recession then.
The yield curve steepening, right? Apparently this usually happens at the start of rate cut cycles. And of course, it's associated, Mike, with recessions. Although the yield curve in of itself as an indicator has lost a lot of its, I don't know, people are saying it doesn't work anymore. Should we pay heed to it?
Well, I'm pretty sure that's happened in every occurrence, Charles. So I think the jury's still out. But again, I think it's all the data collectively that you try to distill out where the economy is going from here. And, I have the view that we're in this kind of Goldilocks backdrop, a moderation in inflation and a gradual softening and cooling in the economy and the labor force, which is why even though we have the unemployment rate increasing, which certainly in 2000, late 2000 and late 07 was the beginning of the catalyst of the beginning of the bear market. I don't think that's the case today. There's still a tremendous amount of focus of investors on inflation. And the good news about unemployment rising is that it takes a lot of the pressure off of the inflation pressures.
All right, so before we wrap it up, I've got to get an assessment of where you think the Fed will cut rates, and maybe if you think, Claudia, that where you would like to see them cut, and where you think they may begin to cut.
I would have liked to have seen them already cut. I think the inflation progress had been real, and the outlook for inflation, which has come to pass, was very favorable. But it's the Fed. They were being very cautious, and they were leaning very hard on the labor market being as strong to give them more time. They need to stop leaning on the labor market, and I think we hear that from them. They're going to try as best they can to go slow and gradually, and I hope the economy holds up with them as they have waited. So we should get going.
All right. Hey, listen, by the way, I'm in the camp with you, and I'm no economist, but Mike, it felt maybe 3 or 4 Fed meetings ago when all of a sudden Jay Powell kept bringing up labor as a shock, and during the Q&A session, even without even prompted. I was guessing maybe 4.1, 4.2, but so many folks have said, no, they need to see maybe 4.5% before they start cutting. Are you on board with that?
No, I think that's outrageous. I think the Fed should be cutting proactively and cautiously so they don't have to cut reactively and aggressively, which is always bad news for the economy because it creates a much bigger whipsaw in the macro cycle. So I agree with Claudia. They should be cautiously starting to cut rates, not be so data dependent. There's plenty of evidence that higher rates are having an impact on the economy. I'm not saying they should aggressively cut, but they certainly, in my opinion, have enough evidence to start the cycle.
Wow. Hey, having both of you on at the same time is like a NBA All-Star game. Claudia, Michael, thank you both very much. Appreciate it. See you soon.
Thanks, Charles.